Yes, so today I'm excited to present some joint work with my colleagues, who I'll introduce to you in a moment, on loss aversion and exploration. So think about exploration in a business context, right? You have a company that can invest in innovation. They can try to develop a new product, or they can try to enter a new market. And this is going to involve some kind of risks, right? It may pay off. They may actually make a larger profit for doing so, or it may not pay off, and they just end up wasting a lot of money. And what's interesting about this kind of exploration is that you don't immediately know if it's going to work. So it's going to take some time, some ongoing investment, to see if there's actually a return at the end of it. And so the question then is, right, do you take a risk? Do you keep investing in this exploration? Do you persist and try and keep going? Or do you eventually give up and just say, cut your losses and exploit a known option? It's known as the exploration-exploitation trade-off. So let's take two companies. Let's take Awesome Incorporated, right? As a profitable company, and they can do some kind of investment in a new idea, or they can try to expand into a new market. And they currently have profits that are positive, right? They have earnings of, let's say, $10, and they might increase it up to $30. Sounds good. On the other hand, you have Gloomy Corporation. They right now have earnings that are negative, right? They're losing money. They're losing $10. And by trying to take advantage of the same opportunity, they might actually make some profit, right? They could get to a positive $10. And so you'll notice that in both of these cases, the potential gains from exploration or from expanding into a new market are the same. They're both $20. But for one company, it's profit to more profit. And for the other company, it's going from losses into gains. So you might think about which of those companies is more likely to expand, which one is more likely to explore into this new market. And you might have heard of the saying that necessity is the mother of invention, right? If you really feel that you have no choice but to try something new, then you may have to risk it. So this is joint work with my colleagues, Alicia Jin, who's at the Securities and Exchange Commission, and George Lowenstein at Carnegie Mellon. And at this point, I should also say that this research does not reflect the position of the Securities and Exchange Commission or any other branch of the US government. OK, so the title has loss aversion, right? What is loss aversion? It's pretty simple. It's just that people are motivated to avoid losses. It feels bad to get a negative outcome where you have less than when you started with. And the canonical example of this is like risky betting in horse racing. So you see that people take some risks early on in the race day. They start to lose money, and now they try and make up their losses. They don't want to end the day in the red, and so they make larger and larger bets as the day goes on to try and recuperate their losses. So that's taking risks, right? And the question we're going to have is, can we reframe identical outcomes? So we don't change anything about the economic incentives. Can we just reframe what an outcome looks like? Does it look like a gain or a loss? And then does that increase people's willingness to engage in exploration and try new options? And we're going to do this in a stylized experimental task. So it's going to be an online experiment where we control the environment and we just change how we frame outcomes to people. So the game we developed for this, we call this the grain game. And the basic idea is that you have a participant who plays the role of a farmer, and they play 70 rounds of a game. And in each round, they can choose to either plant a seed in a specific location, or they can, and they observe the outcome. And then they can choose whether to keep planting in that location or move on to another field. And so we're going to have a gain-only condition. And there the outcomes are all positive, right? It ranges from 0 to 25 points. And we have a gain-loss condition, which ranges from -10 to +15 points. So you can see it's simply shifted down by 10 points. There are 70 rounds, and so we give those participants an initial fund of 700 points. And so the economic incentives are exactly the same, right? The range of outcomes is the same. But for some people, what they will observe is a loss, and some people will never observe a loss. And participants know this range of payoffs, so they know what's possible for them. So here's what this game actually looks like in practice. So you can see each of these locations has a payoff. You can see this is the gain-loss condition. So all the way on the left, they have a payoff of -4. All the way on the right now, they have a payoff of +11. And so at each round, they choose which location they want. And they can only move to adjacent locations. So they cannot just jump back and forth. They have to move one field at a time. So here's one landscape that we give them. Here's what the underlying payoffs are, right? They start off all the way on the left at position 0. And you can see in the gain-only condition that they get a payoff of about 12 points, right? So it starts off just above 10. And for people in the gain-loss condition, it's just shifted down by 10, right? So this dotted line is a 0 payoff for them. And everything below the dotted line is a loss in that condition. And so if you think about our prediction, right, I mean, given the title of this talk, you may expect that there's going to be more exploration in the condition with losses. Right? It's about using loss aversion to encourage exploration, but actually that is not the prediction we make. Right? We make a prediction that there's going to be less exploration when people face losses. Why is that? It is because you have to persist through a range of losses, a range of bad outcomes, until you can actually get to the outcome that is positive. Right? You have to go through the lows in order to reach the peak. And if you want to avoid losses, you're very likely to give up. You're just not going to get to the other side, and you say, I'm going to cut my losses and return. Right? So this is the payoff again. And you can see you have to go through this lengthy trough there. You have to go through over 10 periods of incurring losses until you get to the other side and you experience this peak. So then we can look at what people actually did, right? How far did they explore in this game? And we have a very simple measure of exploration, which is just what is the rightmost location that they have reached during this task. So how far to the right do they go? And exactly as we predicted is that if you only experience gains, you actually go further in this task than if you also might experience losses. Right? People don't go through these persistent cases of losses to get to the other side. And as a result, because exploration is favorable in this task, the people in the gain-loss condition actually end up earning less money in this experiment. So the question then could be, right, do losses always make people worse off? So they didn't explore much in this case, they have lower earnings, or losses just bad? Well, we can just imagine a different environment, right? We can imagine a case where exploration is unfavorable. That is, where if you keep going, you're actually earning less because the high payoff comes early in the potential outcomes. Comes more on the left, right, in the early stages. And so now, going further is bad for your earnings. So we make the same prediction, right? We expect the same case, that in the event of losses, so for people who might experience losses, they're still going to explore less. However, now the outcome is different, right? Now not exploring actually leads to more earnings and should lead to a better outcome if you're in this gain-loss condition. That is, loss aversion should prevent you from exploring when it's unfavorable. And that is exactly what we find. So for participants who can experience losses, they don't explore nearly as much as those who don't have losses. And as a result, now their earnings are higher. So this suggests that losses may just discourage exploration, right? So we have losses. People don't persist through them. So maybe any setting where there are losses, people will explore less. And whether or not that's good may depend on the environment. And that's what we found so far, right? So far, it has always discouraged exploration, and it may have been good or bad depending on the underlying landscape. That's what we observed, right? The same behavior across the environments. And the only question for whether losses are good or bad for your outcomes is just what did the environment happen to be? But of course, participants didn't see this landscape, right? So how would they know? So is that really the full story, right? A loss is just bad for us. Or a loss is bad for exploration. There's one distinction we should make. We should make one between experiencing losses, that is, you're actually in this environment and you're getting a negative outcome, and anticipating losses. So you know that losses are possible, but you have not yet experienced them. So in our experiments, we told participants what the range is. And so once they started getting to the low outcomes, they might have told themselves, I'm not going to take further risk, right? I give up. I stop here. I don't want to experience a loss. And so we're going to develop one more study where we have a more complex landscape. So where instead of just having this single peak, we're actually going to have many peaks. And instead of initializing everyone at the same location and seeing how far they go, we're going to give them a random starting location. And so some people are, even in the first round, already going to experience some losses. So now the analysis is a bit trickier. Instead of just looking how far people travel and how far they explore, we have to see how likely they are to explore given a certain outcome. Because they're no longer starting at the same point, all their initial conditions are going to be different. And so that will be our analysis, right? What is the probability that you go and try a new location given the outcome that you have just observed in this round? And we're again going to compare this between two conditions where one simply has shifted the payoffs down and can experience losses. So this is what this more complex landscape looks like. Instead of having everyone start in one location, right now there's like 700 positions. We randomly initialize where people start. And you can see that exploration is going to differ depending on where you are. So if you're in one of the low points, maybe it's very advantageous for you to keep moving. On the other hand, you might already be at a very high spot, in which case you don't want to move as much. So for all the way we're going to look at this data, it's going to depend on what the payoff is at your current location, right? So if someone in the gain condition gets a payoff of 7, how likely are they to move to a new field? Versus an identical person in the gain-loss condition would experience a payoff of -3 because it's just shifted down. And then how likely is that person to move to a different field? And so here's just what I'm plotting on this figure here. So you can see in red, it's people in the gain-loss condition. And everything to the dotted line at 10 is a loss for them. So the people in the gain-loss condition, right, they're experiencing losses at that point. But people in the gain condition are just getting small gains. And so you can see everything to the left of this 10. People in the gain-loss condition are much more likely to go and explore a different option. But then as soon as you cross over, as soon as you get to the point where people in the gain-loss condition just have a small profit, right? Maybe they have an outcome of 1, but they know losses could happen, they become less likely to explore. So they stop looking around because they don't want to risk entering the loss domain. There's a different way we can plot this data, which is just the, I think we've lost the screen here, which is just the difference between these two dots, the red and the blue dot. And so what you can see is to the left of the 10, it's pretty clear that the gain-loss condition is always higher. And then immediately as you cross over, people are discouraged by the possibility of the loss. So we can ask ourselves, what's a loss? Right? We've talked about loss aversion and this idea that people don't want to experience losses. But in this case, we've introduced a loss purely through a framing manipulation. So all the relative incentives for moving to a different field, the relative attractiveness of every option remains unchanged. It's just that we changed the payoffs by reducing 10 tokens from each outcome, and we gave them 700 tokens at the beginning of the experiment. So relatively, they should be doing the same thing because the economic incentives were identical across conditions. And so it shouldn't have an effect on behavior, but it does. And it does exactly as a result of this loss aversion, right? This not wanting to experience a loss. And so when you think about losses, you can potentially induce them strategically, right? So you can induce losses even when there aren't any through reference points. So imagine that you have an outcome that is a profit of $50,000. And it sounds like a gain of $50,000. But if you frame it as having a $100,000 target, so if you have an objective to reach that's 100,000, related research in this field shows that people treat it as a loss. So even though 50,000, right, is a positive outcome, it's not as positive as people had expected, and so they think they have lost out. So what's the takeaway from this? First, exploration is fueled by hope of potential gains. People take these risks and they make these investments because they think there is a better outcome at the other end, right? And this desire to get the better outcome is what motivates them to take this risk. But it's constrained by the fear of potential losses. People don't want to experience these bad outcomes, and when they think they're getting close to that, they will stop moving and they will stop exploring new things. And then exploration is motivated by wanting to avoid experiencing losses. So when you're actually experiencing losses in the moment, it's extremely painful, it's extremely unpleasant, and so you'll do anything, right, to get out of that and to actually have a positive return again. So then how do you apply this? So if you want people to take more risks, if you think you're in the kind of environment where exploration is rewarded and where people should try more things, what you really want to do is you want to remove the fear of potential losses. You don't want people to think that if they take a risk and it doesn't work out, they're entering the loss domain. Because then they will become risk averse and they will not want to try new things. On the other hand, again, if you want to encourage them to explore more, you can create the feeling of experienced losses through a framing manipulation. You don't want the company to actually incur losses to motivate people, but you can frame things such that they seem like they're missing goals, right? Objectives are not being reached, and it motivates people to try something new and reach that goal. And of course, all of that depends on being in an environment where exploration is rewarded. This is very much going to depend on the context, although we often find that in the real world, taking these risks can pay off. And with that, thank you for your attention.
I'm just kidding with you, but how do you apply this to academic research?
I think deadlines are a good use of this. In academic research, we generally don't have deadlines unless there's some grant, and then you can drag on your work for very long periods, speaking from personal experience. But then when you have self-imposed deadlines and you start to feel that you're running late, it's more motivating to really try and wrap it up. You can think about discovering new research topics. That would be one way of exploration, right? And so what's at stake if your research idea doesn't work out? Well, if it means not getting more grants, if there's a large punishment for that, then it's not worth taking that risk, right? But if you feel there's a very high upside to taking a risk and having it work out, I think that would be a motivating way to do it.
Thank you. Any other questions? I actually have one question myself, David. Hong Kong, the Hong Kong government has been struggling about encouraging people in Hong Kong to venture into entrepreneurship, creating new ideas, startups, for example. And what we have seen is that apparently the innovative culture in Hong Kong is not as strong as those in the United States or some other cities in Europe. I can see a lot of connection of what you do here in terms of loss aversion and exploration to the problem that we are facing. So in this regard, do you think you can actually make any advice based on your finding about how we can encourage people, younger people especially, to venture out into the comfort zone and explore new ideas, into entrepreneurship, for example?
Fantastic question. I think one thing I've noticed about the US environment is that failure is not a mark of shame, right? Entrepreneurs will fail. There were serial entrepreneurs who on their third or fourth company, and the first 3 have failed, but they somehow convince investors that they have figured out how to do it better. And so it seems that the downside risk of failure is actually not very high. Versus I can imagine that in Hong Kong, there's more of a stigma to having run a company and failed than there might be in the US. And so potentially finding ways to avoid that downside, right? Either through things like disclosing how people have failed before, sort of these failure CVs that have become more common in academia, or otherwise providing sort of a downside risk insurance might be one way to go about this.
Okay, very interesting. Thank you. Thank you for the suggestion. Okay.
I have a quick question. So I think this one is just a psychological research, I guess. So my question is, have you imagined how can this apply to some more real scenario? So could you give some examples or some suggestions?
Yeah, I think, so as you say, right, this is a lab experiment. I think one way where we're seeing this play out, although maybe more extremely than I would suggest, is Elon Musk's takeover of Twitter, right? They have gone from, well, they were in the loss domain already, but they certainly went a lot further into losses, right? They were very aggressive cuts, very big changes, but they actually seem to have innovated a lot. So they've launched new features, they've launched new products, they've launched major changes in the last few months relative to the last few years, right? I think the biggest change they've had before, I think, was like increasing the character limit of tweets just a little bit. And now they have all these new services or these new subscriptions. And it seems that when they're actually in the lost domain, right, they really have to try. And it may be what's also motivating people there to work harder. Now, I think the best way to go about this would be to induce losses through framing, not through actually incurring losses. But it's one way, right?
I have another follow-up question. Once again, coming back to my entrepreneurship example in Hong Kong. I remember your diagram, in one of your diagrams just now, you show that the gain-loss exploration extent and the gain-only exploration extent differs depending on their starting point. And I remember those people who explore the most are the ones who are in the negative, and those who are in the very positive. But in the middle, those are the people who are less explorative.
Correct.
Am I right? So that sounds like exactly what we see in college graduation today, isn't it? Most people would desire to look for an average job, paying a decent amount of money. Very few people would go for, starting their new companies, ideas. And of course, the rich group, the people who already have a lot in their endowment, they will be able to invest their time and effort. Do you see a connection here in this phenomenon?
Oh, I think that's really interesting. I could even imagine something like, what your GPA is.
Yes.
Or like, right, if you're just above a cutoff, do you take the class that might be very difficult but have a very high upside if it works out? And I imagine, exactly as your intuition is, that people will not do this, right? They want to stay above. Similar with earnings, right? If you already have some safe job that's an outside option for you, then maybe you'll take bigger risks and, go for a very high-paying job.
Then I'm going to move on to the more difficult question. What should we advise, for example, a university to do or the government to do to encourage this middle group of people to go out of their comfort zone based on your findings?
Fantastic question.
Maybe framing? Is that a way?
That may be, right? Because if we think about something like a GPA, we give it numeric scores, right? So if you go from 3.01 to 2.99, that feels like a very big difference, even though it's a tiny difference in the actual grade. And so potentially shifting away from some of that might actually work. Yeah.
Thank you. Another question.
I'm not having a question. I think it's kind of like similar. Reminds me of like a market efficiency. Like for example, like in the capital markets, like investors, they tend to be maybe overwhelmed by the hope of potential gains. For example, the valuation just fluctuates. It's pretty much the same like the behavioral finance. And when people are losing money, like the valuation tends to be super low because of the loss aversion. I think it's just a quick comment reminds me of the things like that. It's the same as the behavioral finance, what I learned. a market tends to be inefficient in the short run. Yeah, that's what I'm thinking of. Thanks.
Yeah, that's a nice connection. Thank you.
Thank you very much, David.
Thank you.
Thank you.